lot of mid-caps which are holding up in trade. The breath is not looking bad at all. Coromandel International up 2.25% as we speak. That intraday graph will just come up for you on your screens. That's, of course, Ashok Leyland. Coromandel will just come up for you on your screens next. Gujarat Gas has been a big buoyant mover of late, and today too it puts on another 2.5% in trade. There's GMR Infra which is holding up 2.5%. That, of course, is a news-based move. And then, of course, Bajaj Finserv, a relentless move coming in both the Bajaj financial twins. They continue to hold out. Where's Realty then? Let's check in on that particular segment of the market as well, considering this was the one which really pulled us out of the woods in Tuesday's session. And today too, you're seeing solid moves come in on all Realty players. A little tempered though for Godrej Properties, but Oberoi Realty and DLF, the stars from Tuesday, they continue to hold out. In fact, talking about Realty, who better than Ashok Tyagi, whole-time director and CEO at DLF, joining in on the show right now to give us a color on where Realty as a pocket is headed. Ashok, great to have you on the show. Welcome back to ET Now once again. I want to start by talking about your recently launched Panchkula project. Tell us a little bit more about that, and does this now bring you closer to reach your FY23 pre-sales target of 8,000 crores?
Hi, so good morning. As we had indicated in the beginning of the year, while obviously NCR continues to be a large part of our sales and growth engine, we were exploring other geographies, and Panchkula, and not only Panchkula, the entire Chandigarh Tri-City of Mohali, Panchkula and Chandigarh itself, continue to be extremely strong focus areas for us. We had like a pre-launch a few days back, which has been extremely well received. These are independent floors that we are proposing to sell in Panchkula, and those have been extremely well received. And clearly, I think we do believe that the guidance that we had given of about 8,000 crores of sales across the year, should by and large be on track.
But tell me, Ashok, you've always been a very dominant player in your home turf, that is the NCR region. Panchkula is slightly outside of that. Should this be read as a precursor that we will start seeing more of DLF across the country and not just a NCR player?
So if you go back slightly in history, in the post-IPO phase in 2008 to 2010-11, we had bought lands in large parts of the country, including a very significant track in the Panchkula and the Chandigarh Tri-City area. I'd say that given the tailwinds that we are seeing in the entire sector and other geographies right now, we believe that this is the right time for us to start unlocking those land parcels that we have in those geographies, and not unlocking them by selling them or disposing them off, but by actually developing them and, being able to sort of leverage the market conditions. So we had a launch in Chennai in March this year. We are having this launch in Panchkula now. And you'll continue to see, some of these launches in other geographies. We're not buying new land parcels there, but these are land parcels we already had. And we believe that the market today is ripe for us to start unlocking these to their potential fully.
And the market is also very, very excited, Ashok, I must tell you. I was just going through one of the notes, and, with Panchkula launch, the market believes that that's going to instill unlocking value in the land bank that you just talked about. So after Panchkula, what's next?
Okay, so, the sales pipeline that we had indicated shows almost like a 35 million square feet, about 45,000 plus crores in the next 4 to 5 years. So we will have launches in Gurgaon, obviously. We had a lot. If you look at this calendar, we had a massive launch in Delhi in January. We have continues to have launches of our independent floors, the mid low-rise housing in Gurgaon in different pockets and in New Gurgaon. We had the launch in Chennai, and now we have the launch in Panchkula. We clearly are looking at more launches in Gurgaon in the remaining part of this fiscal, both in the low-rise, which is the independent floors as we call it, as well as hopefully, one more group housing scheme coming towards the end of this year. And, we'll continue to explore other new markets. We are in a very focused manner looking at doing one housing project in Goa, where we have an excellent piece of land. We are just exploring the different alternatives there. We should have one more, reasonably big launch in Chennai, maybe towards the later part, the later part of this year or the early part of next year. So you will continue seeing, obviously, a continuous stream of launches in Gurgaon, but also launches in these other geographies as well through the year. And hopefully through the next couple of years as well.
Mr. Tyagi, good morning. This is Nantara. Good to have you on the show. I prepared my questions taking a lot of cues from what Mr. Rajiv Singh, so media reticent, the chairman, said at the annual general meeting. There he indicated that mortgage rates going up could have limited risk but should not impact demand. Now, Mr. Tyagi, we are talking at a time when, okay, interest rates are going up, but the demand is very, very robust. Look at the kind of launch pipeline that you're talking about. The question I think our viewers and your shareholders will want to know is that what price is DLF getting set to raise prices? Are prices going up in each of these launches? Are prices going up also in your existing projects?
Okay. So, great question, Nantara. If you really see, I'll begin with an example, which is the most extreme example of the DLF City independent floors. We launched the first product, I think, in Diwali of 2020. And I think we launched at about 11,000 rupees a square foot price. The pricing today of our current launch is almost 17 to 18,000 rupees a square foot. And the market continues to absorb the new offerings that we keep on bringing to the table. So it's not that a 50% increase in 18 months is going to be a rule of, to be used across the board. But I'm just giving you one example where the market has been able to absorb price increases of a significant magnitude, where they knew that this is like a limited availability product, which will not be there maybe a couple of years down the line. And it was a great location and a great product offering. Overall, as we have indicated, I think in our last analyst meeting in the end of March results, we have seen this entire commodity pricing inflation to basically take us to maybe approximately a 15% increase in the cost of construction, which translates broadly in our product basket to about a 5 to 6% inflation in sales on an annualized basis. We believe that the market continues to be extremely receptive to absorbing that degree of pricing inflation of anywhere between 5 to maybe 7 to 8% on an annualized basis. And I think we will continue to be on that trajectory, unless, of course, the market headwinds or maybe specific products may have some local geographical issues which may at times not allow that. But generally, I think a gradual price strengthening should continue in the market for the next couple of years.
Okay, so you're going to start to see price hikes being given by one example of 11,000 rupees to 18,000 rupees a square foot in just one project in less than 2 years. Now, Mr. Tyagi, we often talk about DLF being the largest real estate developer. A large part of that portfolio is, of course, the office space. As Indians go back to the office, companies are reopening. Can you give us a sense of what's happening there? Because, that's where also you have such a large position. Have you normalized rentals? Are occupancies back to pre-COVID? Are you also in a position to start launching new office projects? I do see one in Gurgaon. When I drive from Delhi to Gurgaon, I do see a big one that's coming up. What's happening in the office market?
Okay. So, Nantara, the one big call, which at times in retrospect could have looked a brave call then, but we took it along with our partners GIC, was that even in the height of COVID, which is basically, I'm talking of mid to late 2020, we did not defer the capex on our proposed projects. So we continue to build downtown in Gurgaon, which is the building that you see as you drive past. And we are building at almost a 2.5 million square feet first phase of the downtown Chennai. Our third project, which is again coming off now, is the joint venture that we have with Hines, also on the national highway, just opposite the DLF Gateway Tower, the shipbuilding as it's loosely called. So we have continued to, accelerate our capex on that, because we believe that by the time these projects, emanate from the construction stage and get ready for occupation, hopefully the cycle should have come back to normal, which luckily has sort of happened. We did have about a year of higher vacancies, as you all know. Our vacancies shot up from 3 to 4% to almost 15%, pretty much in line with the other big players as well, which are now beginning to moderate down to about 11%, I think is the June end number, if I recall the Rentco team telling us. The rentals have begun to normalize now. The increases, the annualized increases, which were in some degree of, moderation in 2021, have begun coming back on track. And, like both of these downtown buildings that you see are now 100% pre-leased. We have a very significant pre-leasing commitments already in place for the Chennai project, And I think the office market seems to be coming back from an occupancy level. Chennai and Hyderabad are almost in the 60% plus occupancy now. I mean, occupancy, I mean that people who are back in the offices. The Gurgaon piece is, I think, still in the ballpark 40 to 50% range, but strengthening every month now. And so I think Indians are coming back to the offices for sure.
Right. So, Mr. Tyagi, our final question, with the retail footprint that's going to go up, something again that was discussed at the, in the speech by Mr. Rajiv Singh, something you're talking about in this interview, as you build more malls, as you build more offices, have rentals already gone up? Are they normalized? Are they back above pre-COVID?
Malls, as you know, are a combination of a fixed rental and a revenue share. I mean, honestly, the shopping levels, the footfall levels, they are in most of the cases already approaching COVID levels, in some cases exceeding COVID levels. So I think we are clearly seeing an extremely strong, like what is called a V-shaped recovery happening in the retail space ever since the lockdowns lifted, which is the reason we were enthused enough to recommence our capex on the retail mall side. I mean, finally, the downtown Gurgaon, which will hopefully be the iconic mall for India, is in the active pre-design stage right now. We should be hopefully getting it off the ground in the next, within the next 9 to 12 months. And I mean, there are other malls and shopping complexes coming up, one in DLF 5, one in central Delhi, one in Goa, one in New Gurgaon. And I think we continue to be extremely enthused by the buoyancy that the retail space has sort of, demonstrated ever since it has recovered from COVID.
Mr. Tyagi, just one more thing, given the sizable land bank unlocking that you're already setting a foot in, I just wanted to understand, while it sure enough does add to your revenues, but could it also come at the cost of some debt levels? Because while you have reduced net debt by about 421 crore rupees during the quarter gone by, does that in any way derail your debt reduction plans going forward? Because this is also going to, sort of entail a large amount of capex, I'm guessing.
So our net debt numbers today are about 2,000 crores right now. And our net debt to equity ratio is like a 0.06 or something, in that sense. So honestly, the net debt number is no longer a number of active concern. We believe that the net debt will keep on coming down because the free cash flow is now becoming extremely organic and well integrated in our operating model. The newer projects that we are doing on the residential side of the business, we believe are self-financing. We are not buying any new major land banks unless, of course, we come across something which is extremely tempting from a strategic standpoint. But otherwise, we are not investing in land disproportionately for sure. We believe that most of our projects will be self-funding. On the rental business, and the rental business, unlike the developmental business, is a debt-intensive business, because it's a capex-intensive business. But there also, we believe that our annual rentals to debt levels, which are currently in the range of 5 plus, should keep on declining because as our free cash flow keeps on strengthening post-COVID, we believe the free cash flow should be more than enough to pay for the capex bills as well as to pay for a certain degree of dividend servicing from Cybercity to DLF. And we don't honestly foresee a debt increase even in the rental portfolio for sure. On the development portfolio, the debt levels will keep on coming down, and now they'll keep on coming down organically, not through any disposal actions or anything extraordinary.
Okay, good to hear that. And markets as well are liking all your talk. The stock's still holding up 1%. Mr. Tyagi, always good to have you on ET Now and chat with you.
Thank you.
Okay, that's